Hello, welcome to Strictly Money at the News Forum, where all voices matter. I'm Saijal Patel. If you're an investor who has an investment portfolio that balances growth with wealth protection and income, you probably have a sizable exposure to bonds. Except that the performance of bonds, like the stock market, have been underwhelming and choppy, to say the least. Well, if you're wondering what you should do with your bonds, this show is for you. Dominic Siciliano is head of fixed income with Industrial Alliance Investment Management, and he joins me now with his insights. Dominic, great to have you on.
Thank you for having me. Nice to meet you.
So, understandably, I think a lot of relatively conservative investors are nervous, right? Because they have not only seen their equity investments go down, they've seen their fixed income investments go down as well. How would you read the bond markets right now?
It's been a very difficult year for investors. It's hard, I think, to get a grasp on why am I losing money in my bond market in 2022. It's the inflation story. I think inflation is really important to understand how that affects asset prices and how it's a bit of a curveball for the Fed. So if you look at the chart that we have right now, the Federal
It's
Reserve initially thought about raising rates to 3.25, and the market was thinking that rates would stay there and above for a longer period of time. When we look at what the market's expectations are today, is a rapid rise in rates, which are going to bring us probably somewhere between 3.25 and 3.5. But because it's going to lead potentially to a recession, that's what the market's calling, the Fed will have to adjust its rates and lower it. So if you look at that curve, that's hence the crash landing or the soft landing. I think the Fed calls it. I call it a crash landing, where you're trying
mm,
to raise rates really rapidly to slow down the consumer. And I think they're hoping that the disruption trade that's due to the situation in Ukraine, the geopolitical worldwide, will at that point reabsorb itself, and then it'll be able to readjust its rates. So that's their theory for the soft landing. The markets are thinking probably, as the chart demonstrated, back to 2.5 in terms of the Fed policy rate, somewhere in 2024, 2025. So up we go, and then probably an adjustment lower. That's what the market is thinking.
Yeah, it's interesting when you look at the bond markets because, Dominic, I've always believed that the bond market is actually has a better pulse on the economic outlook than even the stock market. Would you agree with that?
Usually, I would say yes, because I think on the traditional bond side, their interest rates are so tied into the economy that the bond managers will see those impulses in the system a lot faster. So I
Mm.
think without saying there's a predictability, I think the bond managers have a better grasp of the direct impact that the Fed will have in the economy. In certain cycles, the Fed is a little bit less important, but in this particular cycle, the Fed obviously is really important. So I think the bonds are going to be a leading indicator for where the economy might go.
So the central banks raising rates very aggressively. I think the thinking is that they'll start cutting next year. I know I'm certainly in that camp. Do you agree? What do you expect?
I think the September 21st meeting is going to be crucial. I think Powell hinted at the last meeting that we might be at an inflection point. So if inflation does not come off, and we saw oil prices today, I think we're off 35% off the highs. So that should definitely help some of the inflation story. But if the inflation is really persistent and they don't see a turnaround, we'll see what kind of resolve the Fed has, if that's really what they want to control. So SEP 21 will be crucial if in either indicating that we're close to getting to a pause, and then we'll watch the economic developments, because we are technically in a recession. We've had 2 negative quarters. Some will argue that employment has not, we haven't seen a lot of job losses, but you heard the news last night on certain tech companies cutting
Hmm.
employment, and we're
Yeah.
seeing those type of trends. And employment, in all honesty, if you look at the empirical evidence, is usually a lagger. You get, when the employment impact hits, we're already in the recession. So
Okay.
that's why I think at this point, I'm in the camp that the Fed will try to get close to 3.25, but then because of the impact it has on the consumer, they're going to have to readjust and not make the economy crash, and probably look to lower rates somewhere in 2023.
Okay. Dominic, we only have about 40 seconds until the commercial break. Can you just remind viewers about the relationship between bonds and equities?
Yeah. So traditionally, I think when you don't have an inflation story, you will have bonds act a little bit like a balancing act for your portfolio. So they're supposed to protect you when equity performances go lower, and when vice versa, when equity is really rallying, sometimes the bond market's returns will be not as attractive as the bond side. But when you throw inflation into the mix, and we haven't really had inflation since the 90s, right? So when you throw inflation in the mix, all asset prices go a little bit haywire. But that relationship will come back online, and that's why it's so important for investors to keep their balanced portfolios and to reinvest.
Welcome back. Dominic, before the break, you were talking about how we haven't seen inflation like this since the 1990s. And we do have a board that we'll bring up. What sort of similarities and differences are you seeing now compared to then?
We have two things. We had a bit of helicopter money, or a lot of money that went into hands because of the COVID crisis. And then you have a geopolitical situation that's causing disruption. So this inflation scenario is a little bit different because it's not only driven by, let's say, higher wages or a specific just oil shock. It's really a geopolitical situation, and it's not clear when that's going to reabsorb itself. We didn't have the situation with chips missing for cars, or computer chips such as missing for cars, or those type of situations. So we have to get through that to get the inflation situation under control. And I think that's why the Fed wants to raise rates, because they're trying to control the demand side. They can't really control the supply side, right? So they're trying to say, okay, let me get the consumer to slow down. Kind of makes sense, because if you look at the 90s, and I think I make this reference all the time with my family. I mean, we had, my parents had a credit card in the 1990s. I think it was still in the plastic wrapper. Nobody actually used credit for other than buying their house. Now today, you buy your televisions, you buy your car, you consume only on your credit card. So the direct impact that it has on the consumer when you raise rates right now is really impactful.
Yeah. Let's talk about the opportunities then in the fixed income space. Government bonds. What would you advise investors do if they want exposure to government bonds? Do they keep their duration short? Should they go long, 5 years?
I still think that the mid to short term duration is very interesting to have. I think if you look, these are like cycles, and your portfolio managers do this. Like we do this in our accounts. We're going to start considering going overweight the provincial space, for example, which is a quasi-government. There's a lot of yield to go get in provincial space. So, for example, a 30-year Ontario bond, you'll get about 95 or 100 basis points of additional protection in the long end. I think we should maybe have your portfolio skew a little bit shorter in the 5 to 7 year bucket, and that becomes interesting. So these are things we're doing in our portfolios right now, where we were, I would say, in flatteners to a larger extent into the portfolio, and then now we're looking to add some government credit. And what I mean government credit, it's CMBs, anything that's I wouldn't say guaranteed as a AAA, but something that's very solid because it has the ability to taxation and has a great track record, that type of credit. And then eventually, I think as we get closer to this roll into, are we in a recession or not? When we start talking about recession or hit a recession, I think that's when corporate credit becomes really interesting. It's already widened significantly, as you know, IG has moved. If you use 5-year IG, maybe from 50 to as high as 105 down to 80. And I think now it becomes interesting to get back into that credit cycle a little later on in the fall, especially if we get a pause signal from the Fed. But we're already seeing that, the market is driving the Fed policy a little bit here with, 10-year rates at 265, 270. So, and we've had a strong bid on the corporate sector, because I think people are seeing there's value. If the rates stabilize, there's value to be long in credit. And then I think high yield too has been pushing in for that also. So there's a bit of a market timing with that. So if you're asking for an individual, I think it's difficult for some individuals sometimes to make those calls. So in most fund managers have the ability to do that in their portfolio, where they can go overweight or underweight or add. And I think that's what people are doing right now. They've cleaned up the quality of their credit portfolio over the last couple of months. And now I think slowly but surely we're going to start increasing our credit exposure.
Dominic, we have about a minute or so to the next break. You mentioned corporate bonds. What are you seeing in this area?
Well, there's two markets. So the US market is, I would say, a little fragile these days. We've had supply recently in the marketplace, and it's not really outperformed. It's been pretty steady. In Canada, though, it's a different story. Canada's a very closed-end corporate bond market. There's not a lot of supply, especially in the long end. So it's been pretty steady, I would say, in terms of the value. And I would say the quality of the Canadian names is also, I wouldn't say higher, but I think there's better stories in Canada. So we still like corporate bonds. It's a question of timing right here, but we're going to start to probably apply a little bit more of an overweight, probably in the fall, as we get a better, clear indication, like I said, on the economic call and the Fed's actions.
And the quality of the profits are it's still okay right now here in Canada?
I think so. I mean, we're going to see some impact, obviously, on some of the earnings, but it's still very, very good. I don't see any dire warnings on that, and that's why maybe even the equity market is not in a bad place. Especially if we continue to see consolidation in the equity side. People are saying we're in a bear market, but if we go a little higher here, there might be an opportunity where the market might adjust a little bit more. So the equities look like a good space also.
Dominique, you wanted to make one last point, so go ahead.
Yeah, just quickly, the correlation also between the bond market on the corporate side and the equity market, I think, has never been as high because we've had more, I would say, triple Bs in the corp index. So it's a little technical, but I would say the correlation is probably a little bit higher than we had in the 90s or early 2000s, where it was higher quality names. Once again, a triple B in Canada is still a very good quality corporate bond. It's not all triple Bs are equal. The rating agencies will just probably disagree with me, but it's our take on it. So that's one thing where we've seen a lot of higher correlation between the corporate space and the equity markets too. That's why some things are moving together.
So that's interesting then, because if there is higher correlation, how do you diversify? Or what do you look at then?
Yeah, that's an excellent point. I mean, I think it once again depends on the level of sophistication. I think you have to look at your portfolio as a personal pension plan. So you should always be rebalancing your portfolio when there's moves. And you can work with your advisor, or you can have your own plan, but a 60-40 rebalancing the portfolio. I think that's the best thing to always have. And it's not performed well in the last year, but it's really a mathematical outlier. And I think when those things happen, it's an opportunity for you to rebalance your portfolios in that. If you are comfortable with making calls in terms of different managers, in this cycle, you probably, when we had rates starting to rise, you probably want to go in something like levered loans, a little shorter duration products, and maybe shy away from pure credit plays because of the economic cycle that's going to have an impact on that. So that's one way to do it. And also have a manager, when you buy a bond fund, ask the manager, can you buy tips in his portfolio? How much duration leeway does he have? Can he manage the curve effectively? Or is it more of a closet indexer? Because when you're buying an ETF, you're in a closet index, you're basically just buying what's the index. So I think the active management in these type of turmoils really make a lot of sense. When the water is very, very calm, I think ETFs make lots of sense. Yeah. But when you have turmoil and this type of activity, that's where the manager really can shine. And I think that's why most managers are outperforming their benchmark.
Yeah, and let's talk about that. And by the way, tips, Treasury inflation protected securities, which I also want to ask you about there. GICs, I want to talk about that because they have been out of favor for quite some time, right? You didn't earn much interest.
No.
Now 4% on a year, maybe slightly more on a 2-year. When does it make sense? And I'm going to bring up a board that you have that sort of looks at the pros and cons of GICs and bond funds, because I want to talk about the bond funds as well.
Excellent. This is not all encompassing. It's a few ideas and a few things to think about. GICs make sense always in your portfolio. You should have some, especially if your daughter's going to university and you need an insurance that you have the money to pay for a certain event. If you have an outflow or cash flow, they make perfect sense to have in your portfolio. The disadvantage with GICs is that it's a market timing issue. And also you're locked in with your money, so you can't have access to that money for that period. And it looks very attractive, 4% for a GIC, and I think it does make sense for certain portfolios. But if you look at the bond performance from June 30th to July, the bond market earned 3.25% in 1 month because rates readjusted. So just a broad index, so there is an advantage to having a mix of that. So I would say GICs are an important composition in your portfolio, especially when you have expenses. But I don't think it's something you should consider as a long-term investment. the beauty of a bond fund is that it's a perpetual fund.
Yeah.
In other words, and the concept is that it never comes to issuance, but we're always reinvesting the coupons at the higher rate. So if you look at the charts, let's say from 2020, you were reinvesting coupons at 1.5%, and your GICs were giving you basically zero, if not, I would call it almost negative yield. As opposed to now, with the rates moving higher, you do take a hit on the capital appreciation side. But as a manager, I'm reinvesting now in all these higher yielding securities. We have access also to a wider pool. There's no fees for us when we trade because it's an OTC market. There's fees for the clients to participate in the fund, but for us, there's no fees. So we're always able to optimize the portfolio, and we can make those calls. Like, we can buy tips in our portfolios. So is that something we want to do or not? We can move along the curve. So you give some of that discretion away to the bond manager. But we can't reiterate your tax situation and also where you are in your investment cycle. If you're a couple of years away from your retirement, you have to think about that. If you are still 10 years to retirement or longer, you should not have a concern. And I think the funds make more sense than the GICs for the bulk of your cash.
Can investors get exposure to tips here in Canada or real return bonds?
I would recommend really going through a manager. The tips market in Canada, the Bank of Canada has reduced the size of the issuance. It's a bit of a very technical market. It's a market also driven by pension plans, so it does not always make sense. I think the trading in that for an individual to buy is very difficult.
Okay.
So either I would try to put my money with a manager who has the ability to put some in his portfolio.
Welcome back. Dominic, can you talk a bit about the impact that these rates are having on the consumer and, mortgage rates and general borrowing rates? And I ask this because I keep hearing this argument all over social media, that, well, in the 80s, we saw double-digit rates and this is nothing. And, and I keep saying, but the environment is very different today than it was back then.
Absolutely. And I think some of it has to do with housing. If you look at housing prices in the beginning of the 90s, or if you go back to the 70s, you would have your house would be a multiple of your yearly salary, maybe twice. You could maybe make $15,000 a year, and you could buy a house for $30,000, $40,000. Now, as you know, the average income for a family is maybe 55, but yet your house is now costing $1 million in Toronto. If you find one, right? So that's the point. So I think that the leverage that is needed by the consumer to just have a house has changed. And plus our spending behaviors, because of globalization, and I think access to credit has become so easy.
Yeah.
Some of it is through QE, but also through the banks wanting to increase their profitability, which is not a bad thing, but it's been more credit in your hands. So if you look at this chart, it's just from the Bank of Canada, it's just one measure. It's not the best measure, maybe, but it's one measure. And our economist, Sébastien McMahon, recommended that I look at this. I think you look at the 90s, we're about 6 times more levered in terms of our credit consumption. This excludes household, your house. So, people, like I mentioned earlier, they're buying their cars, their furniture, their televisions, everything is levered through credit. So when you raise rates, you're having a direct impact. I think David Rosenberg corroborates this in one of his podcasts. He talked about 4% overnight rate being the equivalent to 12%, just because of the fact that people are so levered in their consumption.
Yeah. You talked about quantitative easing. Do you think that the ability to sort of even evaluate the bond market has been distorted because of it?
I think where we've felt the disruption was really in the credit markets when we had spreads super tight, and maybe some of the economic value wasn't there. Like, we've had historical lows in terms of tightness, in terms of the spread compression. So I think that led people to say, don't forget, just a couple of cycles ago, we were talking about negative yields, right? So people were just looking for anything with a positive return. So that, I think, led to disruption. And I think we're feeling a bit of the backlash. And that's why credit's been a little bit more volatile in that space. And I think we have a generation of people that only had mortgages in, the 2%, the 3% range, which is, historically very, very low. And now they have to face the fact that mortgages might be more in the 4 to 5 range moving forward. Because I think even if we hit a recession, this concept of we're going to lower rates, but unless it's a really deep recession, I still think that the Federal Reserves, whether it's Canada or the US, are going to want to keep rates like above the 1% mark. So I wouldn't expect mortgages rate to go back to, I would call it 0%
Okay.
in the short term.
What are you watching for now that signals that there's maybe that normal relationship between bonds and equities, that it's back?
There's a couple of things. I mean, the biggest disruptive factor for me has been the inflation story. So as I mentioned earlier, with oil prices dropping, if we can get some food inflation, because some of that disruption trade has moved out, if we do have some, I think entrepreneurs are very smart in finding the new ways to access products and to realign their supply chain. So if that happens, I think we're going to get back a normal balance between relationship between equity and bonds. If the inflation story persists, if the geopolitical situation does not reabsorb itself, Europe has a sword over its head because of the winter months are coming. And what will Russia do? Will they cut the supply? Will they play that game with Europe? So that's going to cause a lot of geopolitical tension. We also have a lot of elections potentially coming up in the European landscape, new governments, especially like in Italy, where we might have a right-wing government. So all these things are going to maybe add to the tension. So those are the things we're looking at. And geopolitical, it's more difficult, I think, for somebody who's not in the markets every day to really get a good handle on it. Even us, we get blindsided all the time by something we didn't predict was going to happen in the marketplace. So those are things we'll be watching in the fall. So it's going to be, I'm a bond geek, so it's going to be a super, super interesting fall, starting with the Fed on September 21st. And then after that, with all the geopolitical situations happening towards the end of the year.
All right, I'm sure it is. And Dominic, we'll love to have you back again to discuss this further. Thank you for coming on today and your insights.
My pleasure.
Dominic Siciliano is the head of fixed income with Industrial Alliance Investment Management. Well, that wraps up this episode of Strictly Money. Each week, I interview experts on financial issues Canadians care about, from inflation to retirement planning to housing. And if these issues matter to you, then head to thenewsforum.ca and catch my previous shows. Thanks for watching. We'll see you next time.